Good morning, ladies and gentlemen. It's good to see you. Pardon my absence for last month. My wife just had our second beautiful daughter. She's healthy, she's well, and I'm back. And we're going to make sense of what is happening in the world today. Our guest is the newest market researcher, writer, and contributor to Silver Chartist, my good friend Steve Penny's new newsletter. And so we have Kyle Heinemann here today. He's got a fantastic story. In 2019, he was starting to see cracks in the credit markets. He was able to turn this into over a 50 bagger, 50x return on his investments. And we're going to be breaking down what's happening, where are we going, and what you can do about it. And if you want to see more of it, make sure you let us know in the comments right there down below. Special shout out to Vizsla Silver, one of our favorite silver and gold mining stocks. We're also going to link the Silver Chartist newsletter pinned to the comments and in the description right there down below. Wishing you a beautiful day. I hope you are well, and let's dive right into this. And Kyle, it is nice to officially have you on.
Appreciate it, Jake. Appreciate the opportunity to come on, and I'm sure that your subscribers have been missing you for quite a while here, but awesome to hear that you've had baby number 2 and that mom and baby and the rest of the family are healthy, and just appreciate you having me onto the show.
Absolutely. So I knew a lot about your story before you started working with Silver Chartist, since Steve's a good friend of mine and he's your best buddy. And I thought we'd start off with, you have a good story. I forget exactly what it was. You made 6 or 7 figures speculating in the markets, and have been studying what's been going on for quite some time. So why don't you give us a little backstory?
Yeah. So my backstory, Steve has been best friends for close to 15 years, since about 2008. We were both military pilots back in New Mexico. Deployed several times together, and just kept in contact with each other for like I said, about the last 15 years. I was kind of there at the very beginning when he started to launch Silver Chartist. So that was really exciting. So I kind of feel like I've been a part of that team and a part of that community for a little over 2 years now. But yeah, as far as my story goes, I've been let's just call it, I finally awoke to the situation that we are found ourselves in, monetarily, financially speaking, back in 2008, 2009, kind of post great financial crisis. And then I just went down the rabbit hole, so to speak. Probably spent way too much time, 4 or 5 hours every single day, just studying the monetary system, the financial system, the capital markets, the debt markets, just to try to understand the difference between what we were being told and what actually was a pretty large gap of reality, so to speak. And from that point, as I just became a little bit more clued in on the reality that we were facing, obviously one of the very first things that I saw that I took a great interest in was obviously the gold and silver community, as a form of savings and just a form of insurance. But specifically to what you were asking, the trade that I had made, I'd have to rewind about 3 years. So back in 2019, in the fall, there were a couple of other commentators at that time that saw something in the fall of 2019. And I called them, in my last couple of weeks commentary for Silver Chartist, I called them credit earthquakes. So what I saw in the middle of the night, there was something happening in the credit markets over in Europe, in the LIBOR, the London Interbank Offering Rate. Basically, when we close our banks, there's still obviously banks that are loaning domestically back and forth to one another in the middle of the night. And I saw that the Federal Reserve had to basically step in night after night after night in the form of tens of billions of dollars and then hundreds of billions of dollars. And this didn't happen just one night or 2 nights or 3 nights. That happened for a series of, let's just call it, a little under 2 weeks. And I knew at some point there was something very, very wrong with the credit markets. And this was sometime around late September, early October of 2019. Now, what I wrote was that there was no way that I could have ever foreseen that they were sniffing out or something was about to happen in the overall global economy. I would have never been able to realize or foreseen that there was going to be this thing called the coronavirus. And like I've said to the community, that regardless of what you think of what the coronavirus was, is, where it came from, if it was leaked, so on and so forth, is that was one of a very, very large, there was a large issue in the credit markets that materialized, but it didn't materialize until 4 to 5 months later, basically January, February of 2020. So what I've been saying, and what I continue to say, is that it's not the problem that concerns me. It's always the response to the problem that we should be paying attention to. So in that regard, the moment that I heard 2 weeks to flatten the curve, that was sometime around March 10th, March 20th, something like that in 2020, the moment that the US central leaders said 2 weeks to flatten the curve, I knew immediately what the response was going to be. And that response was obviously a credit impulse in order to temporarily remedy or offset this massive deflationary impulse that the central banks and the central authorities have basically created. So ahead of time, I knew that what they were going to do is they were going to shut down the global economy. They were going to lock people down in their homes, and that this was going to be a massive deflationary impulse. So that wasn't the problem. The solution to the problem was that the central banks and the moneyed interests around the entire world were going to flood the system with credit and with capital in order to offset that impulse. And so the trade that I made prior to them doing this in March of 2020 was I selected the most risk-on asset. Why? Because I knew that their solution was going to flood the system, and I wanted a leveraged seat at the table. And I knew at that point that that market was crypto. And I knew that specifically the altcoin market was going to basically catch on fire. And so what I did is I went out into the market and I did a lot of research, basically in between that point of the fall of 2019 and that deflationary impulse in March of 2020 when the world was being locked down. And I selected a couple of different protocols, but I took a pretty substantial bet in a blockchain protocol called Cardano, and the coin was ADA. At that point, the interesting thing, and kind of to what you and Rick Rule has mentioned in the past, is that any 10 bagger or anything with the potential to multiply your wealth in a very short period of time also has the ability on a volatility basis to go against you in the short term. So what I told Steve in the community is that I bought that protocol at 5 cents a coin. And during that deflationary impulse, that coin went from 5 cents to 2 cents, actually just under 2 cents. So in about a 2 to 3 week period of me purchasing it in a fairly substantial size, I had lost, so to speak, about 60% of my initial investment. But I wasn't in it in the short term because I knew that this was going to be something that took many, many months in order to play itself out, and it would result from trillions of dollars of credit and guarantees that the central banks around the world were going to have to do in order to flood the system. So subsequently, after it went down to sub 2 cents, it went to almost $3 a coin. And, like Rick and other very, very smart people have said before, is that an amateur trader or a retail trader is typically, it's very easy to say, I'm going to buy the low and I'm going to sell the high. So what you attempt to do is you try to buy within maybe 20% of the bottom and sell within 20% of the top. So buying at 5 cents, I scaled out, and the majority of my position was sold anywhere between $2.30 and $2.50, which obviously netted me somewhere between 46 and 50 times my initial investment in it. So my point with bringing that up with the community at Silver Chartist and your subscribers is that the mindset that you have to have when everybody else is extremely fearful during a deflationary impulse you don't look at the situation at hand. You look much more ahead on what the moneyed interest in central banks and the people in central power and control are going to do as a solution to that problem. So that was probably fairly long-winded, but just to give you guys kind of a heads up of my story, and especially within the last 2 or 3 years, kind of my thought process on that. And we can go into further if you want.
Fantastic. So let's talk a little bit about that deflation, because you said we were entering a deflationary situation in 2020, lockdowns, closures, et cetera. Now, the difference between then and now is there was an infinite, seemingly, amount of money printing that occurred in response to that. Whereas today we have 6-7% for, interest rates for everyday people. And tomorrow's the midterms. The betting markets suggest that Republicans will take the House and Senate, which would, obviously be a gridlock, probably no more stimulus for the remainder of Biden's presidency, if that occurred. In addition to that, you have housing market really starting to get hit, 401ks starting to get hit, the rental market starting to get hit, used car market. Every day, it seems like a new large company says they're laying off 20% of their workforce. In addition to that, I don't see inflation stopping at all. All I see is the only places that Americans save in their assets, house and 401k, going down. I don't see eggs going down. I don't see milk going down. I don't see yogurt going down. You've seen a temporary restraint in gas as they've sold millions of barrels of emergency reserves. That's going to skyrocket after. So you're not seeing quote unquote inflation drop. So you're in this precarious situation. And I wonder how you make sense of it, where deflation fits into it, and given your keen observations about 2019, 2020, how you make sense of it and where you think it goes from here.
Yeah, so that's a fantastic question, and there are brilliant analysts on both sides of that. I just a couple of days ago I listened to a podcast with Stephanie Pomboy, Lacey Hunt. They're both, and Jim Rickards. They're both on the, or actually all three are on the side of deflation. And then you have other people that are on the side of inflation. Where I stand personally is, like you said, 2.5 years ago, I was very, very concerned with inflation. There was no such thing as a free lunch. I knew what it was that they were doing, especially when they said 2 weeks to flatten the curve. Like I said, there's nothing more permanent than a temporary government program. So the moment that they said 2 weeks, I know that those 2 weeks was going to turn into, I didn't exactly know what it was, but I knew that it was going to be in terms of months and years, not just weeks. So what I would say to you and the people that are going to be watching this show is that what I foresee is that let's take a look at inflation, CPI and PCE, is that those are both extremely lagging indicators. So what I see right now, and what I wrote last week for the Silver Charters community, was an article entitled Generals Are Fighting the Last War, or Fighting the Last War specifically. And what I meant by that was the Fed, again, is fighting the last war in terms of the problem and what is the solution that they're attempting to provide. So for 2 years, they went in one direction with a very easy and loose monetary policy. And that pendulum has swung so far out of balance that, like you said, real estate, both residential and commercial, gas prices, food prices, supply chains have been completely severed because of COVID, and we're not going to put them back together, certainly within a couple of years' time. Like, that's just absolutely wishful thinking, and it's not going to happen. It's going to take probably close to a decade in order to get that system or a new system back online. So what I see the Fed doing is the pendulum has swung so far out of balance, and they're fighting the last war in terms of inflation and the trillions of dollars of credit that they have created and flushed into the system over the last 2.5 years post-COVID. So now, rather than be concerned with what has already happened, I'm much more concerned with what is going to happen. And two of the extremely lagging indicators are CPI, PCE, and unemployment. Both of those numbers, the Fed is typically a dual mandate institution in terms of price stability and full employment. Okay. But recently, within the last 2 or 3 months, they've basically said that they are a single mandate institution. And what they meant by that was they are just going to solely focus on curtailing inflation. But what they're doing is they're looking in the rearview mirror, which obviously is very small, and looking behind them rather than what's ahead. And what's ahead is they have embarked on the largest and quickest interest rate increase campaign in history. And what I said to the Silver Charters community is that they are, if it's not the single worst policy decision in their, since 1913, their campaign for, central bank authority, is that it's right up there. It's definitely one of the top 1, 2, or 3 policy errors that they're making. So what I see is that they are tightening into an already severe recession. And you and I both know that the government and the central banks are attempting to change the definition of many things in our society. Specifically to this conversation, they're changing the definition of a recession. But we already know that by its very definition, we are in a recession, right? 2 quarters of negative growth. So we know where we are, we know where we're coming from, but I think that they're still looking in the rearview mirror. And I think that we as investors, speculators, should be looking ahead of us and understanding that PCE and CPI, they're lagging indicators in terms of 6 to 12 months behind us. So by the time the Federal Reserve, specifically to the US, is done, and whether that is February or March, I don't personally know. But I do know that if they continue at the rate that they're doing, whether it's 75 in December and then another 50 in February and another 50 in March, it doesn't really matter, right? Because those eggs have already been scrambled. Like, it's done. People are waiting for the system to break. And what I've been trying to say is that the system has already been broken. You just don't see it yet. And by the time that you see it, and by the time that I see it, and certainly by the time that the Fed sees it, the models that they're using, they will have pushed that envelope so far out of one side of the pendulum to the other side of the pendulum that they will not only have put the physical economy into a severe recession, you're also going to see housing prices, bank deposits, all of these things that are making people extremely vulnerable. They're going to start exploding one by one by one. And by the time that they have the ability to lower, it'll already have been too late. Like I said, those eggs have already been scrambled.
What's interesting to me is I was just reading Neil Kashkari. I think he's at the Minnesota Fed, and he was saying essentially that these employment rates are far too low. And to me, it seems I originally thought they would reverse course heading into midterms. Obviously, I was wrong, and they aren't doing that. At this point, to me, it seems like they are trying to make things break, because if they don't have something break, they can never reverse course anyways. It is impossible for them to just turn around and say, hey, after all this time, hey, we got to reverse, right? Because inflation hasn't slowed down. They've basically are already in a credibility crisis. I think that they are attempting to make things break. So then there's a solution to the breaking of things. And one of the consequences of this is the average American, what little savings they do have is illiquid. It's pretty much in their house. You could say your 401k is liquid, but most people's 401ks are evaporating. And you head into this really weird situation where if you keep going, you have the chance for this to be, in a very quick period of time, for this to be worse than at least any recent levels of economic news or economic crashes. Are you under the assumption that they will not reverse course until something breaks? Or what are you looking at? And what are you analyzing for them to move in one direction or the other? Is it something breaks, or what is it?
Yeah, so outstanding question, and I definitely wanted to cover this because I see a lot of confusion. You hear the term pivot. Everybody's waiting for the Fed to pivot. And I don't know what it means to everyone specifically, but let me tell you what it means to me. The pivot is when the Federal Reserve specifically begins reducing rates. So there's three components that everyone is looking at: them slowing, them pausing, and then pivoting. The interesting thing that I am looking at right now is a scenario where capital markets and the physical economy are two completely separate entities. And I think the retail public and just general market participants think that because we are already in a recession and they continue to raise rates, that we're going to go into an even more severe recession. And I would completely 100% agree that the physical economy will continue to move in a very, very, very severe recession. However, the capital markets itself, I think, are decoupling. And because the Fed implicitly within the last 2 months told us 3 different times that they are solely, like, they are intending to break something. So just like we should not fight the Fed on the way up, let's not fight the Fed on the way down in terms of what our expectations are on the physical economy. What I think is interesting, and probably where I differ from a lot of people, is that I expect the capital markets to move up slowly at first. What I anticipate is the Federal Reserve at some point, and again, I don't know whether it's going to be the December meeting or the February meeting or the March meeting, but what I anticipate in the next, call it 4 to 6 months, between now and say sometime between February and April, is that the Fed will begin leaking language that they are going to begin slowing the interest rate increases. At that point, the capital markets themselves, i.e. the major indices, will continue to move up, not down. Down is what everybody thinks that they're going to do. So general consensus is very...
So basically, you think that they will soon reverse, then you see a further decoupling from, call it, Main Street economy, where that's not just going to turn around in one day, but in essence, they then try to stabilize paper asset prices, whereas you continue to see a further deterioration in the economy?
Yeah, so yes and no. So my anticipation is that they're going to slow. Then a couple of months later, language will be dropped that they are going to pause. And the moment that they say pause, I believe that the capital markets, the major indices, are going to go into, let's call it a melt up, a short squeeze, whatever it is that anybody wants to call it, is that I think major markets, the S&P, the NASDAQ, everything is going to move. Everything is based on algorithmic trading. So the moment that they hear pause, the markets are going to eclipse their previous all-time highs. Now, where they go, I don't personally know. My guess is that the S&P probably is going to move somewhere between 5,500 and 5,800. and the NASDAQ can move up to 20,000, and the Dow potentially can go up to 40,000. Like, these are very, very large numbers. And people will probably listen to this and be like, what is this guy talking about? But because everybody's waiting for the pivot, what I've been saying to the Silver Chargers community is that the pivot is a response to the deflationary impulse. That impulse doesn't start until sometime in the second half of 2023. So as the physical economy continues to deteriorate, the majority of market participants, i.e. retail money, is going to be anticipating those two things, the capital markets and the physical economy, deteriorating together. That's not how Wall Street plays, right? Like, these are criminals, and you're playing in a jail that they created. So they are going to move the markets up and up and up, anticipating that once that Fed says pause, there's going to be a short squeeze. And that short squeeze will draw in all of the remaining retail money that is available, because the fear of missing out, Jake, will be too large for them to just say, no, I'm going to keep all of my capital on the sidelines. No, they're going to want a seat at the table. And people like me, and hopefully you, and maybe some of your subscribers, if this plays out, will be smart enough to exit stage left at that time alongside Wall Street. Because, as you said in your question, the second half of 2023, if this melt-up scenario or the short squeeze scenario that I'm talking about plays out, the second half of 2023 into 2024 is going to be horrible. Worldwide, it's going to be horrible. That's why all the cycles right now are pointing to massive social and civil unrest in the second half of 2023. They understand the cycles. So Wall Street is going to hand over all of their bags to the retail public before they take the opposite side of the trade and they flush it. And they will use that pause and that pivot as a means to do what it is that they're going to do, if that makes any sense.
Makes perfect sense. So let's end with this. What do we need to know? Best ways to prepare. Right now, we're sitting in November. In your opinion, what do we need to be looking at? How do we have to have our heads screwed on? What's the best way to prepare or position ourselves accordingly?
Yeah, so that's an outstanding question. And I wrote for the Silver Chargers community an article 2 weeks ago called The Harvest, right? I'm trying to use analogies that people can understand, not just in terms of, micro analysis, but kind of like a view from 30,000 feet. And what I'm saying is that the harvest is a period of time and duration in which, after you plant certain seeds, you allow weeks and months to actually take place. And then those seeds then they become crops. And if you're a farmer or you are the investor, what do you want to do during harvest season? You want to sell, and you want to sell alongside Wall Street. So the beauty of my thesis isn't that you have to trust me right now. The beauty of my thesis is that all you have to do is watch. You have November, December, January, February. So at minimum, I believe that you have 4 months to watch the markets do what I think that they're going to do, which is slowly at first and then in an accelerating fashion afterward, as soon as they hear the term pivot. And that, I should say, the pause. And when they say pause, Jake, just so you guys understand, the pause might be months in the future, but the very fact that they will pause will be the trigger for that last short squeeze. So right now, I am fully invested, which most people would be like, Kyle, that's absolutely crazy because there's so many different risks. You've got the Eastern Europe on, the precipice of nuclear war. You've had the worst bond market in the last 300 years. You've had the worst 60-40 portfolio start since 1929. You've got the worst, consumer and investor pessimism index ratings or levels in the last 42 years. And that's my point, is that the trade And the pain is not to the downside. The pain is to the upside because everybody's anticipating more pain and more weakness. And I would agree that in the physical economy, there is more pain and weakness ahead. But as far as the capital markets, the pain is to the upside because nobody, or I should say, very few, are anticipating this. So what I'm doing with my own money is I am fully allocated in risk on assets. And the beauty is that you don't have to believe some guy that writes for Silver Chartist. All you have to do is patiently watch and wait and see if I'm proven correct. And at that point, if I am proven correct, whether it be February, March, or April, is that you might have 4 or 5 or 6 months to see this entire scenario play out. And if it does, my point is I want to warn you those 4 or 5 or 6 months ahead of time so that if you see these conditions, you harvest, and you'll harvest right alongside Wall Street, because what happens after that, that's what takes everything down. And there, the World Economic Forum and you'll own nothing and you'll be happy, that scenario plays itself out to the vulnerable people that don't harvest those crops before that time.
Wall Street needs to get their money out. So what I want to do for everyone listening, I wanted to start having Kyle on regularly. I want to go, there's so much I want to go into of what this looks like on the other side, but I don't want the shows to be going on for so long. So if you're watching, give us a comment right there down below that says more please, or love Kyle right there down below in the comments. Smash a like button on this. And I want to do a part 2 where we dive into what it looks like on the other side. And before we get there, diving more into this intermediary term where you're discussing what you believe is coming into the harvest time. So ways people can maximize their opportunities and more importantly, just prepare themselves. And I want to go into that further. So give us a comment right there down below and let us know if you want to see that. There's some important things that I missed that you want to see covered. Definitely let me know in the comments. Kyle, is there anything on, and I know there's so much we can cover, and I want to save that instead of have it at the tail end where people aren't hearing it. Is there anything else that I've missed to wrap up here? And I also want to encourage everyone, check out the Silver Chartist newsletter. It's pinned to the comments and in the description where you can see more from Kyle and the rest of the team.
No, Jake, that was no. There's nothing really to add. I would just kind of finish. I think it's an awesome idea to further delve into, because what I've learned from my commentary thus far is that there's a lot of questions on how to position yourself both ahead of the deflationary impulse and then after the deflationary impulse. And like I said, in the conclusion was that the beauty of my thesis, or the beauty of my position, is that you'll have many months, probably 4, 5, 6 months, to see this entire, premise or position of mine play out. So, like I said, thanks for having me on. Looking forward to coming back, doing a part 2. Hopefully the people that are watching this enjoyed it. And yeah, like you said, I write personally commentary a week for Silver Chartist. So please, come join our community. We've got an awesome team over there. We've got David Brady, and anybody in the gold and silver community knows that David is probably one, if not the best market timer in the world right now. And I say that, and it's not just because I write for Silver Chartist, it's because I've watched him for 3, 4, 5 years. And the guy is the most accurate market caller, specifically to gold and silver, that I have yet seen. We've got Steve Penny, obviously the proprietor, of Silver Chartist, as a technician. And then we've got Jeff Clark, which is, a guy that has been doing, senior mining analysis for decades. So, and then, me as kind of the macro guy, view from 30,000 feet. I think we've got a pretty special team. I think we create a tremendous amount of value. So yeah, I would just encourage everybody, come join the community, take a look at, take a look and see if you guys find value in it. And if not, then look forward to the next time I get to talk to you, Jake.
Yeah, absolutely. So for everyone listening, we'll link it right there down below. Let us know what you think of today's episode. Sorry it was going on for about a month. Let us know. Smash the like button on it. Subscribe, bell notification. Special shout out to Vizsla Silver and Kyle. It was great to have you.